Seriously, it's the only one. It's the only one. If financial advisors are just not doing their job and day trading is not working for you, well then follow me through this video. Oh, the pain of day trading. Less than 10% of day traders actually succeed. And let me explain why. Well, here are the three things. First, they don't have a plan. Second, they don't follow the plan. And third, they let emotions get the best of them. So I've spent 4 years developing the tools and this plan so you will succeed in 2024. Perhaps you're like me. 4 years ago, I wanted to be a high-risk, high-reward active trader. However, day trading just wasn't right for me. So I had to come up with a concept. The point between long-term investing and day trading is swing trading, and specifically for me, I enjoy overnight swing trading. But to be successful, well, that meant I had to find a signal that was over 55% correct. So what did I do? Well, I'll get right to the punchline. After 4 years of success and failure, and success and failure, and success, I finally got the algorithm right. Over the long term. I've had a number of algorithms that were working well but then broke. But my current algorithm, well, it's been running since the beginning of July and it's continued to improve throughout that time. It ended the year after 6 months at 77% correct. And that's not even including the improved algorithms that are currently running over 80% correct over long periods of time. So what is this algorithm measuring? What does this have to do with you and your trading? Well, what it does is it measures what I refer to as the pressure at the end of the trading day, and it tends to correlate to how the market might open the next day. And it's doing it really well. So how do we apply this to our overnight swing trading? We are trading on the overnight gap. You've seen it. The market closes at one point and then opens either up or down the next day. So we're taking advantage of that. But the thing is, we needed to figure out, well, which direction was it going to open? And so developing this algorithm, which measures the pressure the night before, gave us a good clue as to which direction the market would open the next day. And so we would set up our trades accordingly. There are 3 parts to this trade, and the first part is time. You buy at the very end of the trading day and you sell the next morning. Now, it's important to understand how you exit, how well you learn to sell will make a big difference as to how profitable you'll be. That takes time, but in the beginning, just sell first thing. Next is the signal, the result of my 3.5 years of pain and suffering developing the current algorithm. But the thing is, it's free for you on the front page of spytomorrow.com. I make it available to everyone right after the market closes at 4 o'clock Eastern Standard Time. And for most brokerages, or a lot of brokerages such as Ameritrade, you can still trade after the market closes for about the next 15 minutes. And that's where you can buy your ETFs or your stocks and decide which direction you're going to point your trade. So how do we actually trade this information? Well, there are a number of ways to go about it, but it's important to know that the algorithm is based off of a very specific ETF, which I'll talk about in a moment. But let's first talk about a few ways you could trade it. You could trade stock overnight. You could trade ETFs overnight. You could trade leveraged ETFs overnight. And of course, you could trade options. Yeah, you could just buy stock overnight. Take a look at this graph. This graph represents the SPY, which was established in 1993. And what it's saying here is if you bought the SPY in the morning and sold it at the end of the trading day, well, you would probably break even or possibly lost money. However, if you bought the SPY at the end of the trading day and sold it in the morning, well, you would be up over 600%. Now imagine if you could ignore many of those down days. Imagine how much higher that percentage would be. Or you could leverage this information with, well, leveraged ETFs, such as the TQQQ or the SQQQ. What does that mean? Well, the TQQQ is an ETF that's leveraged 3 times, meaning if the QQQ goes up 1%, the TQQQ goes up 3%. But what about going down? Well, if the indicator on the front page of SPY Tomorrow says down, well, then you'd buy the S for short QQQ. And if the QQQ went down 1%, well, then you would make 3%. You can also trade individual stocks, hopefully ones that tend to mirror the market. Now, if you haven't figured it out now, the algorithms are based off of the SPY, which mirror the S&P 500. Now, there are some stocks that tend to be highly weighted in the SPY and the QQQ for that matter, which are Apple, Google, Tesla. And you could actually consider those as your overnight trades. If you really want to be crazy, go for Tesla. It doesn't always follow the market, but when the moves are good, they're really good. Now, if you really want to amplify your gains, you might want to consider options, where you could double your money overnight, but you could also lose half your money overnight. Now, there are a few ways to approach it, and we refer to that as SPY-T trading. However, if you just want to go directional, you'll buy a very small call if the signal says up. If the signal says down, you'd buy a very small put. There are a number of strategies and tactics when it comes to trading options, including buying and selling different combinations of options. And the thing is, when I say sell, I mean selling options into the marketplace. And it is often touted as a great way to earn income. It has an 80 to 90% win rate. And if you have a lot of money or stock behind you, it really is not a bad way to go. However, if you don't have the money or stock behind you, you may find yourself in a position where you owe more money than's actually in your trading account. So we don't play that game here. We just buy our call or put contract at the end of the trading day, and we sell that same call or put contract in the morning with the hopes of making a nice profit. That doesn't mean there aren't any risks buying and selling those options. Of course there are. Options can lose their value quickly if the market moves in the opposite direction of your position. And that's why we consider SPY-T trading, especially in more volatile markets. When the indicators are going well and you understand your risk tolerance, there's nothing wrong with small calls and puts. However, ratio trades, we refer to them as SPY-T trades, are a very good way to protect yourself in case the market does go the other direction. Because yes, we're measuring the pressure at the end of the trading day, but anything could happen overnight. There really isn't anything wrong with a very small call or put trade overnight, as long as you understand position sizing and your risk tolerance, especially when the algorithms are on track, they're doing well. However, when it gets volatile, you might want to consider SPY-T trading, which is a ratio trade. The algorithm measures the pressure at the end of the trading day. However, anything could happen overnight. And if we're in a very volatile market where the market mood seems to shift every few hours, well, then overnight that market could shift mood every few hours and you have no idea which direction the market's going to go. So if you consider a SPY-T trade, which traditionally is a 2-to-1 options ratio, meaning if the signal said up, you'd buy 2 calls and 1 put. If the signal said down, you'd buy 2 puts to 1 call. That is the SPY-T A trade. If the signal said up, we buy 2 calls to 1 put. But there are other trades based off of, again, your risk tolerance and how aggressive you want to be. For example, we have the SPY-T B trade, the SPY-T C trade, the SPY-T D trade, the SPY-T S trade, the SPY-T Q trade, the SPY-T B T trade, and the SPY-T B Q trade, all of which have their purpose, some of which are more aggressive than others. The thing is, day traders do have an advantage. They can place a stop underneath their trade. So if their trade goes the wrong direction, they'll just stop out, get out of the market. And we can't really do that so well overnight. So having that hedge, That overnight hedge, the ratio trade, it helps us sleep overnight because we know if the market goes the other direction, it'll help to minimize our loss or actually make a gain if the market goes far enough. And that is the name of the game. Maximizing our gains, minimizing our losses, using the best signal we can find. And we have a signal that has a track record and has been doing pretty well. But don't just trust it, test it. Watch the signal. It's posted 4 o'clock Eastern Standard Time. Do a paper trade. Pretend to trade overnight. Do it a few times and see how it works for you. Because you're going to have some days in which the market does go the other direction because of news or economic reports. There are a number of reasons why it will change. And some weeks will be better than others. Some months will be better than others. But that's how you measure it. Not overnight. You measure it over the week. How did you do this week? And how did you do the next week? And what could you have done better? Are you getting better at exiting? Are you increasing your patience, which is really important when you're trading? Patience, whether day trading, investing for the long term, or overnight swing trading, patience is really important in understanding your risk tolerance and just becoming a better trader by doing the same thing well over and over again. And you're going to see your account go up and up. Not because it's exciting, it got boring. And if it got boring, that means you're doing it right. Who am I kidding? Watching my account go up is exciting. I'll see you in the next video.